I'd like to welcome everyone to the 24 results webinar. I'm very pleased to be here today to present our results, and I'm joined by Lizzie Tan, our CFO COO, who will discuss more about some of the financial performance questions. The past financial year has been, a very challenging one for the business. We experienced significant distraction and disruption in the second half, which was impacted our operating momentum. Definitely the unrest that the 249D notice caused certainly caused a number of our staff and a number of our advisors serious concerns, and it really did take away management's time to bring back the confidence, and to it did add additional costs to maintain operations. I'm really grateful for the support of Sequoia shareholders, all of them. We've listened to the feedback, and I hope you'll see a positive difference in respect to delivery of the results and the presentations today, and much of that has come from your feedback. Our focus is firmly on growing the business, increasing returns for shareholders, and looking to build a sustainable business for yourselves. What we are is we're a diversified financial services group, and as you would have seen in recent announcements, we're looking to streamline the business. We listen to that commentary about looking to have a much more simpler message so all shareholders can understand exactly what we do. And what we do is, just to make it very clear, again, is we provide services to a comprehensive group of financial planners, wealth managers and accountants. That is our key client. And then we offer a whole range of services. We're larger than a lot of people realise in respect to our funds under advice. So we're 12 billion currently funds under advice across the 350 plus advisors that we have. So there's 350 odd on the financial advice register, and approximately another 30 that are general advice or wholesale advisors that sit. So we're close to around the 400 advisors in total, and we have just over 100 staff. We did have a slight reduction in the number of staff from about 5 or 6% over the 12 months as we did part of that streamlining. I'll move to the next slide. So I think the key numbers are really important to understand where we've come from, and I did mention it. It was a disruptive second half, and that did disturb some of the momentum that we had. We put out to the market that we were looking to achieve around $125 million revenue for the full year. We've come in at 124.6 on continued operations. So we did successful in respect to the revenue numbers, despite some really difficult times in the last 3 or 4 months, which took away management's time and did stunt some of the opportunities that we had. And very pleasingly, the operating profit come out within the range, and that's statutory operating profit here. So 8.7 million on continued business was up 88% on the previous corresponding period. So very, very good result. The net profit after tax of 24 million obviously was heavily impacted by the sale of Morrison's, which was a terrific result. And we continue to hold 20% of Morrison's business, and that sits on our balance sheet as an asset. And we're continually liaising with the business, and that business has continued to do quite well. Operating cash flow from the existing businesses also grew, and importantly, from respect to shareholders in respect to dividend return opposed from shareholder growth return, we've been able to pay 7 cents fully franked dividend across the 12 months. 2 cents of that was an interim dividend in the first half. 2.5 cents of that is a fully franked dividend final. And then we paid an additional 2.5 cents as a special because we had, in our opinion, a little bit excess cash and strong franking credits that we wanted to distribute at this point in time. The 4.5 cents per share annual dividend, though, is reflective of where we're looking to go. We're looking to grow dividends from operating cash flow, less tax, and pay it out to shareholders on a meaningful basis, so that you get some income from holding and allowing us to invest your capital and grow our business. Net cash is strong. At June 30, it was 16.8 million. That's up 79% on the previous corresponding period. And that's despite paying some good dividends and also being quite aggressive in a buyback strategy. Next slide, Andrew. On that point, we have bought back 6 million shares to June 24, so that's 4.3% of the issued capital we've bought back. We do want to continue to support the buyback. We're running out of capacity. I think we have 2 million shares odd left in respect to our ASX notice. But come the AGM, we'll look to renew that notice, but we'll be buying back shares selectively because we do want to maintain a really strong balance of cash so we can fund acquisitions into the future. The licensee service really and the new legal service businesses both had really strong growth, top line revenue growth, and that was for a number of reasons, which I'll touch on a little later. But there's been a really big shift in the need for advice in the financial services industry. I think most investors and most Australians would realise that the days of going into your bank and talking to your bank and then getting referred to a financial planner have gone. Basically, all the banks have left the industry. The second thing is that there's a big generation of wealth transfer at present. So the baby boomers and the people with wealth, you're seeing a big transition of wealth take place, and the need for advice is definitely escalating at a very fast rate. The challenge, though, for people who want advice is the number of advisors is reducing at quite a fast rate at the same time. So for groups like us that are independent to a product as such, the demand is extremely strong, and our results today talk to that in respect to the growth in the revenue number, despite only going up 14 advisors throughout the 12 months. I'll talk to that a little bit more later. The streamlining did see us impose some cost in getting to that point. Everything is expensed. There's nothing below the line in respect to our numbers here. So things like our IT spend and our programmer spend and our documents business fully expensed. Any claims that have occurred, fully expensed. Any restructure of the businesses to take us from 4 to 2, fully expensed. So the $8.8 million number is a real number. It's very positive, and as you can see by the profit share, which I'll talk on before looking at the two divisions, you can see both are growing, both in revenue and in margin. And this streamlining is really exciting opportunity for us. We are looking to divest non-core businesses and form strategic alliances. So whilst we might not be necessarily, general insurance broking was one key area where we initially went into general insurance broking believing that we could be part of the aggregation opportunity, but we've realised that we're too small, and the prices people are paying for general insurance brokerage are higher than we were prepared to offer. So what we've done is we've formed a strategic alliance with a high quality broking firm where we can still refer business to them and get a share of income, but we've divested that to get some more cash back into our balance sheet to concentrate on the legal administration business and the licensee services business, and that's where we'll be looking to make acquisitions and grow. One of the positive things that's come out of the 249D notices is to potentially speed up that process of streamlining that we had talked to prior to the notice coming. I think maybe the notice did encourage us to accelerate that process somewhat, even though the board had already set that in place, and hopefully us taking that type of action now gives some of those shareholders some comfort that we did listen to some of their concerns at the time. The process did see us get a new chairman, so Mike Ryan's joined us. We've had a couple of board meetings already under Mike, and it's very exciting and very exuberant. The board's really is very positive about the future, and we're extremely aligned, and that's an exciting part. So things are very positive, and we're moving forward. And the unsettlement, if that's such a word, that we saw within the staff and the advisor network has really calmed down. We're seeing inbound inquiries now in respect to people wanting to join us rather than having to put out fires, and the recruiters and those sort of things that we're targeting our staff throughout that period has also slowed. So I think that part of our 2024 is behind us, and in some ways it's been a positive shake-up and allowed us to move forward and with new passion and excitement. Dividend growth. I think all shareholders look for two things, I think, or maybe three. But the two things that I particularly look for as an investor is, one is capital growth, and the second one is income from my investments. And I think that the dividend story that we talked about when we first commenced paying dividends under my CEO role was that we were looking to increase the dividends on a regular basis and increase the payout ratio on a regular basis. We've gone from 0.4 cents in full year 2020 when we recommenced our dividends to 4.5 cents per share normalised dividends in 2024. So that's an 83% capital growth return, compounding annual growth return, which I think is a terrific result in respect to the dividends. And we've moved to a maturity phase. We've got $21 million of franking credits at June 30 for future dividends. We do have that strong cash on balance sheet, and we also have some other assets potentially that we could use to divest in time when the time is right to further have a very large piggy bank to pay shareholders dividends. But most importantly, the dividends for the future is going to come because we've got a very good business that is generating cash, and we're looking to pay around 90% of operating profit, less tax as our dividends. So that's the sort of top end of where we're looking to get to, and we have some targets in respect to revenue, operating profit, less tax, and a dividend target. And we are looking to continually grow our dividends. And as you can see, over the 4 years, we've been able to achieve that and do want to continue that experience for shareholders. I'll go into the divisional breakdown. First of all, the streamlined organisation. It's really two areas, with the accountant, the financial planner, and the high net worth investor, trustee type person, the key end client. So the licensee advisor services, we're looking to provide a range of services to licensees, to advisors, including licensing. So definitely licensing and advisor is our low margin business, our high revenue business. We are looking to try and move to a sort of an 8% return on that business on higher revenue, and get a much higher return on revenue in respect to operating profit from those other types of businesses in that. So the type of business I'm referring to there is where you own the financial planning practice, such as our Sequoia family office business, our Sequoia corporate finance business. The margins on those are higher than providing a license for hire or a license to self-employed parties. And that's where we're looking to continue our growth. We are looking to continue to grow our advisors. Last year, we had a net 14 growth in advisor numbers. So we actually were able to recruit 70 new advisors into the license. We saw 56 either retire or move to another license or move to self-licensing over the year. The positive about that was the advisors that we've been bringing into the business are higher income generators than the advisors we were losing. The 70 advisors that I'm referring to that have joined, we expect their income for the 12 months to be about 18 million. The 56 advisors that we're leaving, that we have either retired or merged or moved out of the industry, was about 6 million. So the net growth in respect of organic numbers over the 12 months was very positive. So we're up, double-digit growth in respect to revenue from recruiting, and I think that's extremely positive. The legal and administration services business is really beginning to mature. Stephen Harvey has been appointed as the head of that business. He's had 25 years plus in that sector, working for major competitors. He's a lawyer. He understands the need for high quality documents, high quality information going out to the clients across a whole range of trusts, super funds, legal documents, etc. And in the short period of time he's been in that role, we've really seen an acceleration of the quality of our delivery, and our numbers are looking good. Our sales are up and our margin is up. So I'm really pleased that some of the challenges that we faced over the last 12 months allowed us to appoint such a great leader into that business, and very excited. And I think you can see in that business it's closer to a 40% margin and accelerating as we get revenue, because it really is a software as a service type business, and we are definitely looking to make additional acquisitions into that business. I'll move on to the next slide. Thanks, Andrew. So the revenue contribution, as you can see, licensee services makes up almost all of the revenue. So 113 of the $124 million of continued business is made up of licensee services, and you can see the contribution from the equity markets, 9.1, and the direct investments, 2.2, coming into the new licensee services business. Legal and administration services is 9.3 million revenue, high margin, growing strongly. Head office, small revenue, and other is at 1.9. So that's where you get to your 124.6. We'll move to the next slide, which is the new structure. And that slide shows you where the growth has come from. So growth has come from 98 million of continued operations business, 23 million is growth in the licensee services arm, 1.6 million in the legal and admin arm, which is small but from a low base. So, 25% plus growth there, and head office. So bringing us to 124.6 million. We're not forecasting numbers today. We're listening to shareholders in respect to that, but we are looking to get growth in advisor numbers, growth organically, and we are looking at some acquisitions over time. What we're looking to do is get steady growth and get improved margins to allow us to generate strong operating cash, less tax, pay dividends, and reinvest cash to make acquisitions and improve the business so we can continue that cycle. The operating margin, as you can see, has scaled up a little bit, but is still well below what I'd like it to be. So on the 89.3 million revenue, we generated 4.4 million in licensee services. On the 113 million, we generated 8.4 million operating profit. Obviously, you've got head office costs and all sort of other costs that come out of that. So it's not just a factor of adding up the licensee services, operating profit plus the legal and profit to get your result. However, the margin itself has gone from less than 5 to over 7, which is extremely positive and heading in that direction. So my first goal, the goal for the 12-month period in respect to licensing services is to move that over 8. We've talked for a very long time about trying to get the whole business to over 8. We're now looking more laser-like and more focused in respect to licensing services only, looking to be over 8% and growing the revenue organically on a number of fronts. So we'll talk to that some more later, but 8% is our target operating profit margin for the licensing services business on increasing revenue as a result of more advisors, more services, and better cross-marketing. And I think that probably says enough. I'm happy to take questions into Andrew and really go into your questions rather than just talk to slides. The legal administration service, I think it's a hidden gem that we're now talking about, and we're really excited and we're investing in. We've invested quite a lot of cash, fully expensed in the last 12 months into the two businesses, but predominantly this business in respect to IT. So we didn't capitalise any of the salaries for our IT spend in this particular year. We fully expensed all salaries, and we've spent a sizable amount. But despite that, our margin has gone to quite good numbers, and we're really pleased about that. So revenue 7.7 to 9.3, and operating cash to 4.2. So you can see that the percentage return on that is extremely strong, at creeping over 45%, which is the type of returns that a software as a service business can get to once it's got scale. 9.3 million is some scale. We think we're about 10% of the market. We've bought Panther Corp, we've bought ABS, we've bought Castle Corp, and merged all of those businesses into this division over the last 24 months. We're now starting to see the return on that and the return on investing in the IT parties, and we're looking to see definite revenue growth, but also margin growth potentially towards 50% in the next 12 months. The group financials, I'll talk to them a little bit. I think prefer to take questions on this one and let Lizzie answer those. But I think the key numbers is obviously 7% total operating margins, a 49% improvement. It's very good. It's not enough. As I said before, we want 8% margin on licensee services. We want 45 to 50% margin on the other business, and then obviously try and manage the head office costs to a reasonable number. But we're growing 20% growth, organic, which I think is extremely good for a business like us. And there's plenty more organic growth to be had, and we're sharing that with dividends. We'll continue that dividend strategy. As I said, about 90% of operating profit less tax, and that should maintain our dividend at a very, very attractive yield for people to hold this investment long term. And hopefully over time, we'll see that reflected in the capital growth opportunity as well. Very strong balance sheet. If you're looking at enterprise value, we have at 30th of June, we have $16.8 million cash in the bank. We have a further $5.1 million invested in mostly strategic ASX listed shares. The major one of $4 million of that $5 million is invested in Centrepoint Alliance, which we see as a very good partner of ours in the future. We are in discussions with them about how both businesses can work together and share some services and both be beneficiaries of our investment into Centrepoint. We have no debt. We repaid our $1.57 million facility from operating profit, and we have an undrawn $13.2 million facility. So we've got plenty of firepower if we were looking to make acquisitions with cash, which is something that we're really going to talk to. And I might just talk to allow Lizzie to talk about the $10.7 million investments that we have and also the net assets. I'll pass you to Lizzie.
Thank you, Garry. So just to finish off where Garry was talking about, was the company has strategic investments in Morrison Securities and Uri Asset Management. That is the $10.7 million that we have on our balance sheet. But last but not least, our net asset was $56.6 million, a big improvement of $26 million, up 84%. Just to carry off on our balance sheet as well, we do have a healthy cash balance of $16.8 million, plus $5.1 million liquid share investments in ASX listed companies with good dividend yield. And the company is debt-free and maintains an undrawn loan facility of $13.25 million. Andrew, can we move to the cash flow, please? Our cash flow situation is looking good too. The reported operating cash flow from continuing business was $4.8 million, which improved by 69%. This reflects the strength and growth in licensee and advisory services. The receipts from cash from sale of Morrison has enabled us to fund our active share buyback program and pay dividends at historic high levels in these couple of years. Operating cash flow conversion to operating profit dropped slightly to 56% compared to last year. The correlation between operating cash flow and operating profit was lower than expected, but it is just temporary. As we have not realized the gains in our strategic share investments. Also, we expect the ratio to improve as we see more sales in the new structured product offerings and our legal teams making greater efforts in the collection of debts in the coming year. Thank you, Garry. Andrew?
I might go back a couple of slides and just ask Lizzie to talk about a couple of things on the balance sheet, Andrew.
Sure.
the goodwill and intangible assets, we've written down $7 million on goodwill and tangible assets. Would you like to just discuss the thinking about that?
Yes, those two items, we have done a full goodwill impairment testing based on the two divisions, the old divisions, which is the Sequoia Equity Markets and also Sequoia Direct Investments. So based on our model, it does show that there's impairment existed in both divisions. Hence, we have to impair or write off $2.5 million in Sequoia Direct Investments and also about $3.8 million in Sequoia Equity Markets. And just a little footnote at the bottom of the balance sheet explaining what they were for that $7.1 million. Does that help, Garry?
Yep, no, thank you. I think one of the key things that we're looking to do is to make the so that your DAR is not continually a big number, and we wanted to reflect what we believe to be the fair value of some of those businesses like Share Cafe and Financial News that haven't done as well, and we've taken the hit this year on the carrying value of that goodwill, so that you're not, in future periods, that we're not looking to amortize an asset that's not marked at fair value there. I'll just look to the full year 25 focus before I take some questions. So it's really about, as I touched on before, it's about organic revenue growth, both in the licensee services division and extending our operating profit margin. So in essence, to 8% operating profit margin in the licensee services business and to close to 50% in the other business, whilst growing revenue. So that's the target. Capital management, as I touched on, is that we are looking to pay fully franked dividends at an increasing payout ratio. So we talked about 4 years ago that we were starting at a 20%, 30, 40, 50% increasing payout ratio over time. We've now got to a position where we feel like we've got maturity in our cash flow, and we're heading towards the top end of the ratio that you see companies pay, and particularly whilst we have a very strong franking credit balance. Whilst we don't believe franking credits are going to be removed, we are mindful that the shareholders own the franking credits, and that we want to ensure that we do pay fully franked dividends at the top end of our payout ratio from operating profit after tax, and not reduce our cash as such. So we still believe that if we do that, we'll have an increase in cash balance, but most importantly, give those franking credits and the yield back to those people who invest in us. The second part of the capital management strategy is we will continue the share buyback scheme, but it be used selectively as appropriate to enhance shareholder value. So we've invested close to $8 million now post June 30, including up to June 30, and then again we kept going into this new year, and that's reduced our number of shares to I think now below 125 million from 134 million, which I think's added a lot of value back to shareholders, and we'll continue to do that when we think it's appropriate and to enhance shareholder value. But I think fully franked dividends, capital growth, and some share buyback is what you can expect from us in the future. And it's very much an organic focus and an inorganic focus. So the organic focus will be horizontal expansion. So we still do have a number of businesses and a number of services where one business has a client base that might not necessarily be using the services of another business. So we definitely want to get further horizontal expansion and cross-marketing to this very large customer base that we have. We're definitely going to continue to invest in technology to help improve our margins, and we've seen that in the legal services business, and we're definitely looking to get advisor growth. There's a lot of disruption at the moment, or there's a lot of mergers, and there's a lot of people, licensees moving from one business to another as the consolidation of the industry takes place. Centrepoint talked about it, and I completely agree with John Shuttleworth on this point, is when large groups are acquired by other large groups, there's a lot of disruption, and often you see a lot of those advisors not wanting to go to the new large group. So the groups like Insignia, AMP, etc., and in the next 12 months, there's likely to be fallout from some of those groups where they're being asked to go to a new home, and groups like us will be beneficiaries of that. And I would hope that we can get 5 to 6 new advisors per month, as we did in 2024, again in 2025, and again that the higher margin businesses are those that are joining us, and that's purely organic. So I'm not talking there about acquisition, just organic growth of 5 to 6 advisors per month from our state management team that are doing very well. The legal and administration business, so we're definitely very keen on further acquisitions in that space. Businesses like Panther Corp, Castle Corp, ABS that have come in the last 12 to 24 months have been very good acquisitions, and we want to do more of that. We're continually looking at opportunities there. Prior to the notice of meeting, we were close to one, but unfortunately the disruption caused some disappointment to that. But we are out there looking at opportunities there, and there's some, we're, as I mentioned before, probably 10% of the market at the moment. There's no reason why we can't inorganically grow that market share and put some more businesses together, because we do it very well and we've got a terrific team, and I think there's a great opportunity for us there. And on the licensee and advisor services space, not ruling out a large acquisition, but really smaller acquisitions in where we buy salaried planners businesses. So a financial planning business that might have been operating 20 or 30 years with 4 or 5 staff and all the structures in place where they have salaried advisors. We're definitely keen to play in that space and acquire some of those businesses into our whole 100% owned salary businesses.